after World War II, there was a view in particular of development aid as a way, like, we can make poor countries rich, we give them money. And I'm not saying there's anything wrong with that, but like you can have the private sector do that too, historically. And this is how it would work, right? But it's the same concept of a society is not necessarily able to produce what is necessary in order to facilitate the most growth. So you supplement from abroad. And if you have a place that's older and richer and more advanced, maybe it's beneficial for them to not give things away, right? They get a claim in return, but it can be mutually beneficial transaction. The question is whether that is what's driving imbalances. In the case of the US and other, rich English speaking economies like the UK and Australia and New Zealand, it seems not so much.
Got a very special conversation today. I'm speaking to Matthew Klein, founder of the Overshoot and Unbalanced. Matthew, welcome to Monetary Matters.
Thanks for having me, Jack.
We're here in a year 2025 where a lot of global imbalances in trade flows, in capital flows are being questioned, primarily admittedly by the US Trump administration. You've focused on this issue for a very long time. You're the co-author of a book, Trade Wars or Class Wars, with Michael Pettis. I want to start by asking you, in the conclusion to that book, you say that trade wars are not a conflict between countries. What did you mean by that? And if trade wars aren't a conflict between countries, what are they a conflict between?
So great question. In general, just to back up, trade, we think of countries as being these very important economic units and trade between them as being something very special. But I think it's actually very helpful to zoom out and just realize that there's a global economy. There are businesses and consumers all over the world who have transactions with each other all the time. And some of those people happen to be within, a line that's one country, and some of those happen people be within an area that's another country. And when those people interact, we call it trade or cross-border finance, but it's really all the same stuff happening globally. And so that I think is the important starting point. And our point in general is that you can have all sorts of relationships between different groups of people, different kinds of businesses, different economic sectors. And those can lead to imbalances within a society, and those might be contained within that society. But what generally tends to happen because of all these linkages that connect basically everyone together, unless you're some, hunter-gatherer deep in the Amazon, um, they spill over. And so what happens in one place will not stay in one place. And that can have all sorts of effects, unexpected or otherwise, on other societies. And then people in those societies might, okay, this is a problem. This country, the people here are doing something bad to me and to people in my country. When in reality, the actual mechanism is both more complex and not really that might not be what's happening at all. So, we wrote that book originally, it came out in 2020. We wrote the manuscript in 2018, 2019. And back then, there were sort of two motivations. They were very related. One is this, US China trade conflict and economic conflict that was emerging, in large part to the election of the first Trump administration. And then also the legacy of the Euro crisis, which at that point had been going on for, 10 years. And in both of those places, we saw a lots of sort of national stereotyping and really negative portrayals of people in other countries and their motivations, which were not really either accurate or really helpful for understanding what's going on. So, people would say, "Oh, the Chinese are taking our jobs. The Chinese is a master plan to hurt Americans," or they're just doing it, whether it's a master plan or not. And our point was, well, actually, if you look at what's been going on within China over the past 30 plus years, there's been a lot of internal dynamics related to China's own domestic political economy, and as a consequence of those things, those changes and those internal political conflicts, a lot of ordinary people in China have ended up worse off than they otherwise would have. And as a consequence, people in the rest of the world have also been made worse off. And then within the Euro crisis, again, the similar sort of dynamic of uh, it's not that the Greeks were taking advantage of the Germans or the Germans were being bad to, the Greeks or the Spanish or whatever. It's really that there were groups of people within all these societies who are benefiting and much larger groups of people across these societies who are at the receiving end in ways that were hurting them. So it's not like, oh, Germany, their trade surplus with the rest of Europe was so great for Germans. It was actually mostly a reflection of all these things that were going on in Germany that was harming a lot of ordinary consumers and workers there. And that was really our point, saying, look, we you know, if you look at this and actually what's driving these things, you can have some sort of, cross country solidarity here, people realizing what their actual economic interests are. And that's really the point of the book.
So rather than China's taking advantage of the US or the US is taking advantage of China, is it the elites in the US and China are taking advantage of non elites in the US and China?
Broadly speaking, that's right. I mean, Obviously, it depends on what elites we're talking about, but in general, right? Like there's a symmetry of interest between people in say the U.S. financial sector and people who are company executives and owners of companies in the U.S. that offshore or outsource to production in China, and then the people who own those companies, that offshore production in China, whether they're or people who are sort of getting a taste of it, like local government officials, that sort of thing. And the losers on that, you see them in both sides too, right? Like it's not like people in China have done objectively badly over the past 30 years. Clearly, that's not true. But relative to a sort of plausible counterfactual, the share of China's national income that goes to workers and consumers has fallen over time. And it's fallen over time, not just as like, well, that's kind of weird, right? Like we can actually point to various things and mechanisms that have been put in place by the Chinese government, the Chinese, party state that have contributed to this, whether it's essentially the sort of quasi legal status of the hundreds of millions of workers in the coastal cities who had migrated from the countryside, who are not eligible to receive things like free education, healthcare, unemployment insurance, even though they paid taxes for those things. Uh, it could be the fact that, historically there's some change, right? But historically, you have various environmental regulations that are very friendly to businesses at the expense of people who actually live in the places that are producing and polluting these things. It could be the way the financial system, until relatively recently, was structured to effectively transfer household deposits that were getting very low interest rates to subsidized business loans that were only available to favored companies and favored property developers at very low rates. Lots of particular mechanisms. The fact that adversarial unions are illegal in China, right? And so there are lots of things we can point to, and again, like there's a great book that came out actually around the same time ours, so we couldn't. It was not available for us to cite it, but called Invisible China. It does a really good job by Scott Rosell and Natalie Hell. It does a really good job of actually laying out like what are some of the concrete consequences of this sort of over focus on investment and exports compared to domestic consumption, because these terms can seem abstract, right? And their point is, look, if you focus on the fate of the hundreds of millions of people in rural China who uh, do not live in the glamorous cities, then, in some places, like, it's actually quite bad, the outcomes, like, very low literacy rates compared to other countries of comparable, average GDP per capita, extreme levels of, like, child, illnesses for certain, very basic stuff, like ringworm as an example. I mean, lots of things where it's not sexy like building an office tower or high speed rail, but you see like, okay, there are actually trade offs here in this economic model. And so our point is that all of these things add up in ways that, again, it's mostly the people who are mostly bearing the brunt of this are people in China. The reason this is happening is because of China's own internal political dynamics and political economy, but it does have consequences for people outside. And that's basically the point of the book.
And even though it may be true that the US has benefited in a variety of ways from open trade, your point is it's distributionally helps people in who are executives of corporates who can offshore jobs and send jobs overseas for cheaper wages, people who are in the financial sector who are receiving financial flows from the rest of the world. Maybe it helps people in the media, maybe it helps financial podcasters. Maybe I'm have been a beneficiary, but there are lots of people who used to work in steel mills and used to work in factories that stuff is now being made in China who don't benefit.
Well, I would caution to say, like, it's not open trade per se that's the issue. It's more that, I mean, I don't think if trade had been closed, it would necessarily be better for people. I think the issue is that given that people are connected through trade and finance anyway, and realistically, you cannot cut yourself off from these things. As I said, unless you're a hunter gatherer deep in the bowels of the Amazon, like it's going to, the relationship between what we think of as trade policy and trade openness and your actual exposure to the rest of the world, sort of, there's no relationship there. And so I think the bigger question is, given that we all are living together on this planet in a connected global economy and financial system, the way things have actually played out has been worse than they could have been. And they've been worse than they could have been in particular ways where some people ended up relatively better off, as you noted, and a lot of people ended up worse off. But I think saying like, oh, trade is good for these people, trade is bad, I think is like you could have had more trade or just as much trade in terms of overall, but the way and we have to, it's focusing on the specifics. And really that gets back to things like the distribution of income within these societies, their domestic political economy, and these other macro factors, which I think are actually much more important than what we think of as trade policy per se.
Like what macro factors?
So, for example, right, like the Euro crisis. So before 2008, Europe as a whole, basically, if you were to sort of add everything up together, it would look like it's a pretty balanced economy, right? That as a whole, the continent was basically producing as much as it was using domestically. There wasn't this, dramatic increase in external borrowing or what have you. But that masked the fact that within Europe, there are these really big pockets of imbalances where you have Germany and the Netherlands on one side, basically, and then you have places like Spain and Greece and Ireland and Portugal on the other side. And the crisis happens, and then what changes? Well, the behavior of Germany and the Netherlands does not change. What happens is that you entirely have a one-sided adjustment where the countries that had been, the societies that had been basically offsetting the surplus pathologies of Germany in particular, they suddenly are no longer able to do that for a whole host of reasons that we talk about in the book. And the net effect is that there's just less spending by businesses, by households, by governments. And that's bad for people in Europe, fundamentally. They're the biggest losers from this. They're living in a way that's worse for them. But also, you know, given the scale of the European economy, like Spain by itself is not big compared to the global economy. But if you add up all these countries together, the impact is actually quite large and noticeable for the global economy. And that macro change, which again, Europeans were not thinking, as far as I know, about like what the implications of various changes to fiscal rules would mean for trade balances there and what that would mean for their various trading partners in the rest of the world. But but they had big consequences. So this was sort of domestic macro policy, and what they were thinking of as being sort of an internal concern about public debt sustainability actually had very substantial negative consequences for other countries, whether or not they thought about them. And that's what I mean by macro factors.
So when I said open trade has been good for some, bad for some, you disputed that. Yeah, I guess what I meant to say, and thanks for making me be more precise, is open trade with persistent imbalances that are caused by imbalance trade imbalances that are caused by imbalances in demand and investment, consumption and investment that are policy induced and persistent. And now I want to move on. Matt, do you think? I think I'm sure, like you, I talk all the time to people who you could call mainstream economists, and I think in mainstream economics, there's a view that not only are surplus trade surpluses and capital deficits and vice versa, not only are they can they be a good thing, but they're never a bad thing. And I think you maybe agree on the first point, but don't agree on the second point. So you write how sometimes surpluses are and deficits are neither good nor bad. Talked about what's the difference of a good trade deficit or a good, I guess, a capital surplus, where, for example, in the 19th century, Europe, in particular Great Britain, exported huge amounts of capital to the United States. You say that was a good thing. Norway, for example, was a poor country in the 1960s. It imported huge amounts of capital from the rest of the world, and you say that's a good thing. Actually, it's funny enough. They now have a huge sovereign wealth fund, and actually, the head of the sovereign wealth fund is actually kind of a competitor. He's a financial podcast as well. But so why were those good? But what we currently have in the United States, where we also import huge amounts of capital, why is that perhaps a bad thing? And what's the difference between a good and a bad imbalance?
Right. So just to, again, sort of zoom out here, when we talk about what an imbalance is, it's basically societies are capable of producing so much at any given point in time. And then the question is the aggregate value of what you're producing sufficient relative to what, you'd like to be able to have? Now, in sort of some abstract sense, like obviously we'd all want to have more, right? But then the question is, okay, well, if you want to spend more than you are earning, you have to finance that somehow. So then it's saying, okay, well, how much more do we want it relative to the cost of, getting it, whether it's selling shares or borrowing or what have you? And in general, right, this is not sort of a universal rule, but in general, you can say like there are places that have better growth prospects because maybe they're poor and they are catching up. The sort of classic case would be, Norway, right? We mentioned that one. Norway's a poor country. Then they discovered offshore oil and gas, right? So then they knew they could become a rich country, but developing offshore oil and gas is extraordinarily expensive. And so how would Norwegians be able to pay for that by themselves? Well, you could do sort of the Stalinist approach of basically you starve the peasantry to generate, exports of grain, get hard currency to import the tech and machinery you need. But that is not sustainable in democracy. And, it might not even have worked, right? It's not as if they had a big grain surplus in Norway anyway, right? So the other thing you could do is say, well, you can go to the people in the rest of the world and say, listen, we have this great opportunity here. Will you help us do it? We promise you a nice cut of the future returns. And this is how finance is supposed to work, right? That's the whole point of a financial system, is that you can do things like this. Doesn't have to be cross border, right? It works within countries too. And that's what they did. And it worked out very well. South Korea is another great example, right? Like nowadays, and it's been true for, you know, almost 30 years, we think of South Korea as a sort of perpetual surplus country, stereotypical like Asian savers, right? But that actually is not what characterized the history of South Korea for the bulk of the time it was transforming from a very, very poor country into what is now a rich country. Uh, there were, from the end of the Korean War until basically the Asian financial crisis, South Korea ran persistent trade and current account deficits, which means that people in South Korea on the whole were spending more than they earned and financing the difference by selling claims one or another, whether it was FDI or debt or what have you. And that worked out very well for them, right? Like they became, they knew that they needed to supplement their domestic productive capacities with foreign productive capacities in order to grow and develop. And they did, and it worked out very well. You can also look at the post-communist transition states of Central and Eastern Europe and the Baltics, right? They did this too. And again, it worked out very well for them. So this can all work well. The development of Australia and Canada and the US in the 19th century, right? Again, all of these places, this can be a very good model. It's a way of, you can, nowadays, not nowadays, right? Like after World War II, there was a view in particular of development aid as a way, like we can make poor countries rich, we give them money. And I'm not saying there's anything wrong with that, but like you can have the private sector do that too, historically. And this is how it would work, right? But it's the same concept of a society is not necessarily able to produce, what is necessary in order to facilitate the most growth. So you supplement from abroad. And if you have a place that's older and richer and more advanced, maybe it's beneficial for them to sort of not give things away, right? They get a claim in return, but it can be mutually beneficial transaction. The question is whether that is what's driving imbalances more recently. And the answer is sometimes, depends where you look, but in the case of the US and other, rich English speaking economies like the UK and Australia and New Zealand, it seems not so much, right? I mean, there is a period of time in the late 1990s in the United States where you can plausibly say, okay, wow, we basically struck gold in this country somehow. And so everyone wants to get a piece of that. You could plausibly say the past couple of years, and maybe even now, maybe not right now, but like, a few months ago, right? In the US, the same thing, right? But that, and so that could plausibly justify, people from say Europe and Japan wanting to buy US assets more than the other way around. But doesn't really describe any other, multi-year stretch of time in the US when you think of the world as a whole, right? Like the US was actually doing quite badly from say 2000 to 2008. It was not doing well, particularly from 2008 until, after the pandemic. Before 1996, not doing particularly well, right? So this idea that it's all, it's purely just, sort of benign natural outcome of, profit seeking investors just, going what is the most logical places to put their money to maximize returns. It's not obviously the case. That there seem to be other factors at play here. And I think one of those is just this quest for a degree of safety among different kinds of savers, whether it is official and quasi-official institutions that are trying to accumulate reserves, or just individual rich people in various countries who are looking for places to put their money, whether it's like Miami apartments or U.S. Treasury, whatever. Like these are the kinds of things, or London apartments, right? And so that can have distortions, and that's part of what we talk about in the book.
So the United States overconsumes, or it consumes a huge amount, and it undersaves, it dissaves, and as a result, the rest of the world has to save and then recycle those savings into the United States.
I'm not sure I'd phrase it quite that way. I mean, so a sort of annoying technical thing is in like the economics jargon, saving is literally just production minus consumption. So those things would have to be, but the problem is overconsume. I mean, it's a loaded term, right? Overconsume relative to what? And so, I mean, one thing I find striking is that if you're not looking at consumption as say a share of output, which I think can be misleading, we usually look at consumption in absolute terms, per person. What has it done over time? What you can see is that in the periods when people say, wow, Americans are consuming so much, the growth of consumption relative to some kind of longer term trend that people thought was normal has not been particularly high, right? It's not like the times when the current account deficit really expanded. It was like consumption really grew a lot in absolute terms, where it was just kind of chugging along. The thing that was different and this is particularly noticeable in sort of 2008 period, is that income growth was weak. And so, you can think of it, I mean, this is sort of an extreme, but it's relevant, right? Like if you are working and you earn wage income and you pay your expenses out of your wage income and you kind of have roughly in balance, maybe you save a little bit, right? And then you lose your job, you can cut your consumption quite a bit because, you don't have so much money, but you can't cut it to zero because you'll die. Like you need to eat. Uh, but if you don't have any income, right? Maybe you get some unemployment benefits or whatever, like you have to either borrow or run down your savings. And, y you know, in a certain sense, that is what happened, not to that extreme, right? But that's like the kind of thing that happened to the US over large stretches of time when we have this current account, deficit, and not just the US, by the way. Again, like the UK, I think is a really good example. The UK is a great example also because we talk about the, appeal of growth story. Like the UK has never been considered an attractive growth story by anyone in the world since 2007. And yet persistent current account deficits over that time, and sometimes larger relative to the UK economy than the US. So again, like this is a country that's literally no productivity growth since 2007, no growth in business investment since 2016 Brexit vote, and yet they have been running large persistent current account deficits. So
And why
again,
is
like
that?
well, I mean, look, this gets back to like why do these things happen, right? Like, you could say it's because people in the UK are just determined to spend more than they earn, and everyone else in the rest of the world is just forced to lend to them, right? But like, why would they be forced to lend them? It's not as if they're offering particularly attractive returns. Um, the yields and inflation adjusted yields that you can get on UK assets, and this is true for the US in general, right? Are not particularly attractive. They might be attractive relative to certain other places. If you're comparing it to like Switzerland or Germany or Japan until recently, right? Like, sure. Um, but not relative to, I mean, in theory, right? You could say, wow, there are all these like fast growing emerging markets, better demographics, better productivity growth. Like, it seems like that would be the place you want to. I mean, the places that in the 19th century were, the Canada of the 19th century, right? Or the South Korea of the second half of the 20th century, right? And yet those places, I mean, they are sometimes attracting inflows, right? But first of all, they have to pay through the nose to get them. And second of all, not in anywhere like the actual quantity of financing going to these places relative to what's going to the US and UK is just much, much smaller. And so those are the kinds of things that may think, okay, this is mostly a push factor in terms of where the, financial asset demand is coming from, where the sort of excess production, not excess production in the sense that like they should produce less, but just they're not consuming enough at home. Where that's coming from rather than, oh, Americans and British people have just an insatiable appetite to buy things. Like everyone wants more stuff, right?
Mhm.
It's not like there's some unique cultural characteristic that's different. It's there are times not that long ago when Americans and British people had trade and current account surpluses. I don't think the culture has changed fundamentally. It's the economic fundamentals and distribution of income, other things were different. And I think that's where it's worth unpacking and focusing on those kind of things.
So talk about the distribution of income between countries. Is that's what you're saying that's what is at the heart of this?
It's a big part of it, right? So basically, most people, individuals, over the course of their life, will spend everything they earn. Obviously, at points in time, it's different, right? Like there are points in time when you're borrowing more, like to buy a house or pay for school, or whatever. There are points in your time you're saving a lot to pay those things back and save for retirement. And then you're retired and you're paying it down, right? But like over time, in general, it's supposed to more or less spend what you earn. Very, very rich people are different. And, I'm not like their fault or anything. It's just like it's mechanically impossible to spend that much money on goods and services. To use sort of an extreme case, like Steve Schwartzman gets $1 billion a year in dividend income, right? Like you can't spend $1 billion even after taxes, right? Like that's just an extraordinary amount of money. So you're gonna buy financial assets. Which like again, it's not like a moral judgment, it's just like how it works. And so if you have a situation where you have a shift in the distribution of income to people like that from other people, that has to first of all that only works if everyone else keeps spending, right? Because if people just lose money and they spend less, then the other people can't make more money, right? That's not an actual shift in, that's just that wouldn't happen to be a shift in distribution. So what actually happens in practice is some people, a smaller group, are buying more financial assets in the aggregate, and then everyone else is issuing more financial assets. They're borrowing against it, right? Now maybe it's not households individually; it could be the government borrowing. They're more transfer finance more transfer payments or whatever, right? Like there are different ways of looking at it. But basically, that's the kind of thing that has to happen. And meanwhile, there are companies, right? Like in the corporate sector, historically, has been a net issuer of financial assets. You go back far enough in time. And that makes sense intuitively. You think, okay, it's sort of this basic, simple model like households save, and then like companies will raise financing and they make investments. That has stopped being true in a lot of places at various, since, different starting points. So starting with Japan around 1990, then the US and Germany and Korea around, 90s. Basically, Korea after the financial crisis, and then US and Germany after the dot-com bust, other places after the Euro crisis. Uh, and that's been a persistent shift in corporate behavior. And you add that up enough countries, that again, big difference, right? And so that can take different forms. It could be that companies are just choosing to spend less on capex. It could be they're paying less in wages, whatever, right? That has had a persistent. So you have a shift there, either a shift in distribution of income to the corporate sector, shift in behavior of the corporate sector. That has an impact. And then there's governments, right? You can subdivide this further if you want, but like as a simple example, governments. Now, you think again, governments, they run budget deficits, maybe they make infrastructure investments, maybe they something countercyclical, whatever. Like there are lots of ways you can think about it. If for some reason, some governments in some places either feel constrained or ideologically compelled to just shrink their deficits independent of anything else going on, which is something that was particularly noticeable in Europe since 2008. I mean, starting in Germany before that, but then again, that's going to have it's a shift in the distribution of income effectively to the government sector, and you can say who wins from that. It's sort of more complicated, but again, like these changes, they will all affect the balance between spending and income within a society, and those changes will spill over to other societies. And so that's why it's important to look at how changes in the shift in the distribution of income. It's not necessarily like from rich households to poor households or vice versa. It could be that. It could be other things. There's some overlap, right? Like corporations are generally, or businesses writ large, are generally owned and controlled by the very rich people who are also, a shift in their income. So, you could say, oh, well, there's no shift in the household distribution of income, therefore it's not happening. But if there's a shift from households to corporates, then yeah, it probably is, right? Like especially in places like Germany, where a lot of rich households own businesses directly, their family-owned companies, and they use those effectively as our personal savings vehicles. And so that's the kind of thing that we're looking at and saying, okay, this is like what you need to be paying attention to. It's not the only thing, right? Like in the US, for example, and to a certain extent in the UK, you also saw a shift in the distribution of income in general, among households and from households to corporates that you'd think would lead to, a shift into sort of persistent surplus. And we write about this in the book. Like there are a lot of, it looks actually a lot like what you would have expected based on sort of the German experience since 2000 in the US. And yet it didn't play out that way. And, there are a lot of reasons for this. We talked about, I mentioned some already in terms of the, sort of foreign investors' demand for these kinds of assets and the openness of our financial and asset markets more generally. But it was an offsetting force. That there was in fact a real impulse to what you would have thought is like a surplus. The savings go to the rich is the phrase that Atif Mian and Amir Sufi and Luke Straup used, but it was offset by what was going on in the rest of the world. And so basically, you had this effectively the savings rate, household savings rate of like the bottom 90% of the income distribution. So like most people, went deeply negative at a time that everyone else, you had those other shifts going on. So it's kind of offset, the general pattern.
Okay, now where does China come into this?
So China, again, the shift in the distribution of income has been quite substantial over the past, basically since 1989. And this is something we talk about a lot in the book. And I mentioned a little bit earlier, but uh, the, a lot of government policies, which again, I don't think it was explicitly aimed at trade per se. Maybe any of them were, but they had the net effect of suppressing income growth of most Chinese people relative to income growth for China as a whole. Right? It's not that income growth in Chinese people was not very strong positive. Again, it's like obviously true that Chinese people are a lot richer now than they were in 1989, but relative to the trajectory of the Chinese economy, much less than you would have expected, and that reflects a lot of policy choices. Um, and so, again, the beneficiaries there, it's a mix. Like it could be exporting companies. It could be companies that are connected, favorable credit terms to, develop infrastructure or property. It could be local governments themselves, which until pretty recently, like until say 2021 or whatever, were big beneficiaries because of their ability to, um, make money from land sales to developers and leverage off of that and their collection of, assets. And so all of this was again, it was a shift in the distribution of income away from sort of ordinary Chinese workers and consumers and retirees towards much smaller subsets of the population. And what's interesting is that you can see that it kind of bottomed out for a while, like around 2010. And sort of 2010, 2019, it seemed like the things stopped getting worse. And that is consistent with the fact that, and some things that were actually improving. And that's consistent with the fact that China's trade and current account surplus, which had been expanding sort of relentlessly until about 2007, 8, contracted a lot during the financial crisis and then stayed relatively low until the pandemic. Since the pandemic, we've seen kind of a big reversal. And again, it's instructive to look at what actually happened. So, unlike the US or Europe or Japan or Canada or what have you, the Chinese government did not provide subsidies or any kind of support really to consumers or workers for that matter. Instead, there was some support for sort of loans for producers to keep selling things abroad, but that's basically it. Uh, and so you have a situation where again, I mentioned that you have hundreds of millions of people working in the cities on the coast who don't have sort of legal residence to be there, don't have access to the sort of normal government benefits they pay taxes for, and we don't have the exact numbers here, but like something on the order of like 50 to 70 million of those people during the pandemic went back to being subsistence farmers in the interior because that was the only way they could stay alive and feed themselves. And, then you had a second round of lockdowns, pretty aggressive in 2022, and lots of other things that were sort of all part of this pattern. And what we've seen pretty consistently over the past few years in China, up through now, is that the recovery as a whole has been very weak in China. The recovery in consumer spending has been much weaker than the recovery as a whole, which is already weak. So even though like industrial production in China is like 6% below trend, look like sort of 2013, 2019 trend or whatever, it's like 6% below, give or take. Consumer spending is like 15% below trend. It depends on exactly how you define it, like whether how much of it's nominal versus inflated, but still, like there's a big gap there. And that's reflected in the fact that imports have basically not grown over several years. Exports have grown, right? And the exports have grown for two reasons. One is that foreign demand isn't better than China. And two, that, if you're producing relatively more, your production growth is more than your domestic consumption growth, even if it's weaker than it would have otherwise been, it's going somewhere, right? And so that's people talk about Chinese overcapacity and dumping. And like I find those terms kind of confusing in this context because, you know, because China's own domestic economy has been so weak, it's not so much that it's, there's just I mean, maybe you could argue in certain sectors there's like actual overcapacity. I
You
think the
say
bigger
Chinese
issue is
domestic economy has been so weak, you mean Chinese domestic consumption has been weak?
yes, although the domestic economy as a whole also, right, like, relative to what would have been expected, like you can look at forecasts people made before on the eve of the pandemic and like what would China be doing, whether it's Chinese government forecasts like the IMF or whatever, and you compare that to what's actually happened. So this is for the aggregate economy, not just for consumption. They've had a huge shortfall. It's actually probably one of the biggest shortfalls in the world since the pandemic. Now you can still say, oh, well, they're growing 5% a year. Like that's really great, right? Sure, I'm not disputing that. Although, like, take those even if you take those numbers at face value, but like relative to what's expected, huge shortfall, which is a big difference from say, the United States, which at least up until very recently has grown more than what was expected on the eve of the pandemic. And so that's a big, contributor to these things. And so the rise of the return of China's trade and current account surplus, properly measured, has been quite substantial the past few years, and it's consistent with sort of our overall understanding of how these mechanisms work.
So, China's, current account surplus and its trade surplus in particular is growing, enormously. Why is that a problem? A lot of most economists, as you know, will say that that's not a problem. Why is that a problem?
Well, look, there are two reasons. One is it's a symptom of a problem for them, right? So, as a someone concerned about humanity as a whole, like I know what's happening here. Like it's very clear in the Chinese data, and it's bad for them. Like Chinese people could be living better. So that's problem one. Problem two is if you're not in China and suddenly there's all this stuff coming in that is essentially being produced and sold, below cost for whatever reason, um, that potentially can impair the viability of your own business and employment. And that can be a real problem. People talk about like the second China shock.
Mhm.
Now, again, I don't think what you do about it, there's a lot of options, right? You could say we're just going to ban imports from China. I think that's not helpful to be honest. I think there are things that are more constructive, and we've talked about them. I think um, the simple thing is like, look, if they want to send us stuff fine, but just make sure that we're also still buying enough of homegrown things, right? I think the Inflation Reduction Act is actually a pretty good way of threading the needle there. Of like, we're going to import a lot of things. Some of those things, we're going to give some preference to American made things or U.S. made components. That's now being gutted, so who knows? But that was the idea. Um, so, it's interesting actually. You see the reaction in Europe has actually been much more extreme, with saying like, "Oh, our car industry is going to be obliterated by this flood of Chinese exports." And again, like, I, how much of that is something? I think it's reasonable to say like, you don't want to destroy an industry that employs tens of millions of people and all this other stuff. Just let it evaporate overnight because you just weren't paying attention. And again, like I think the bigger problem is like what's been happening in China. But in and of itself, right? Like these things can be managed up to a point, but it's important to know that this is actually happening, and you have $1 trillion of more being produced in China than is being consumed used in China domestically, give or take. That has to go somewhere, and so some places can manage that better than others. But it's important to know that that's a phenomenon that's happening. And as I said, the biggest losers from this are people in China who are living below their means. But then there are also people who potentially are in a situation where their own businesses might for no fault of their own, just like get wiped out because of these other problems.
And why are they living below their means? Why can't they borrow money? Why can't they spend?
That's a big question, right? So part of it is so first of all, they have borrowed a lot. Actually, if you look at total debt to GDP within China, all the different sectors aggregated, it's actually quite high.
But not
And
household.
no, including households.
Household, okay, okay.
So I mean, the household debt to GDP by itself is not that high in China. Household debt to income actually is quite high because income as a share of GDP is so low. So if you look at household debt to income in China, like the best measures we have of it, it's actually like around where I think it's actually higher than the US is now. Um, well, so that's an issue, right? Like there actually was a huge increase in household indebtedness in China. So basically you can kind of look at stages, right? So before the financial crisis, domestic debt in China was quite low, but there was an implicit increase in debt associated with their growth, which is the rest of the world borrowed a lot to buy things from China. That broke down after 2008. There's a big increase in domestic debt. Some of that is counted as corporate for various reasons. Some of it's counted as government, whatever, like that. That happened. Then you get to like 2014 ish. Government has decided for various reasons, okay, we overdid that. Let's try to slow things down. Debt growth slows in the aggregate. Fixed asset investment growth slows. But then they're saying, "Oh, we want to increase household consumption because I mean, it's not like the things I'm saying are alien to Chinese officials. Like you talk to or read things that are written by any kind of most Chinese economists, think tanks, universities, very mainstream people within the Chinese discussion. Like they basically agree with all these things. They say, okay, let's more household consumption. So instead of the more straightforward approach, what you think is straightforward, which is let's make sure households get a higher share of national income because that's hard. They say like, let's make it easier for households to borrow. And so household debt to GDP, like just goes straight. I mean, straight up.
Okay.
Something on the order of like, from 15% to say 60%, right? In the span of a few years. When again, like given what household income as a share of GDP is, like the increase in household indebtedness for households is quite, and then that stops because it's like, well, it turns out that was not great. Then you have this sort of real estate crackdown you have the past few years. And so there is an extent to which using more debt by itself is would be challenging. I mean, the central government in China has very little debt on its balance sheet. So in theory, it could issue more debt. In practice, if it did that, what would it be doing? Taking the debt off of local government balance sheets or sort of state-owned enterprises. That might help on the margin, but like that's not going to really be the thing that moves the needle. The bigger issue is like you should look at the labor share of corporate non-financial corporate value add. So which is a reasonable way of saying like how much are workers paid relative to what the value that they produce. In China, the latest data we have from just a couple of years ago, so I don't think it's that out of date. It's like 40%, which is quite low. You look at like the US or Europe or Japan, whatever, we're talking, 60%. And that's a big difference. Uh, and so, I mean, things like that. But of course, the issue, and this is something that people in China have said for a long time, including very top officials, and something we talk about in the book. You have a system that evolved and developed over decades at this point to favor certain sectors over others, to transfer resources from households to those favored businesses, local governments. if you want to increase the household share of income, you have to unwind those things. But the problem is the people who have benefited over the years have become, and then again, this is a term that Chinese officials have used, vested interests, and they don't want to reverse those things. And so you look at like, huh, isn't it weird that China, despite whatever people might think of it as like a socialist with Chinese characteristics or
Mhm.
whatever, the income tax is basically nothing. Um, the most of the tax revenue, there is no property tax. Most tax revenue comes from consumption taxes, from payroll taxes, from things sort of like tariffs, right? Basically, a very regressive system. As an example, like why is that not changed? There've been announcements
Regressive
about it.
meaning that if you're low income, you pay higher taxes as a percentage of your income than if you're, a multimillionaire. Yeah, when you buy a
Yeah,
pack of gum, it's de minimis
right,
relative to
right.
your income.
Certainly compared to a lot of other societies, yes.
Yeah.
And so, why is that not changed, right? Like it's fascinating that there has been this intellectual consensus within China for so long that so many senior Chinese government officials have certainly spoken and given as if they understand all these dynamics, and yet we haven't seen these changes. And so that suggests to me that the various vested interests, however defined, are very effective at blocking the kinds of changes that would really move the needle here. Which is tough because, of course, if you think that like they have to change, like I mean, if they say they want to, right, and they're not, so that creates a lot. I mean, if you're the rest of the world, you have to figure out how to manage that. And that's partly why it can be something if you're paying a lot of attention to is like what actually is happening in China will not stay in China, and if it doesn't change, like they're not going to change it, and it has this sort of its own malign issues for you know as I said, China's internal domestic reasons. Like you as a third country, you have to figure out what are you going to do to avoid their problems affecting me, even if you're not saying like they're doing it deliberately.
And so the household share of income as a percentage of GDP in China is small. So who is taking the slice of the pie? The government and then the corporate sector? Because
Yeah.
when I look at the corporate sector, obviously there are some high profile stocks that a lot of Americans are invested in, but like the big stocks, like the big banks, and they typically don't have huge profit margins that I've observed.
Oh no, that's in fact like one of the fascinating things is that the stock market in China is basically flat for 20 years, right? I think it's one of the great, it's a good example of, you think like this is a great, if you'd known 20 years ago how much China was going to grow and you compare it to other countries, it's like in terms of GDP growth, technology, everything, but wow, this is a great place to invest. I bet it's even better than what people were priced in and you would have lost money if you're investing anywhere. So just
Yep.
goes to show how investing is hard. Um, that's why I define index funds. But to your point, I mean, when we talk about like the corporate sector income, like it could be profits that are distributed to shareholders. It could be profits that are not distributed to shareholders. It could be interest. And so these are some of the other things. It could be also companies, some of which are not listed, right? So there's a mix of things there. But I mean, um, how that gets played. I mean, one of the issues with China, my understanding is that part of the reason why the stock returns have been so bad is because stock issuance has just been very high. It's different from, some other markets where, companies are not net issuers of shares, like the US, right? Basically not been net issuers of shares since like the 80s. And any incremental financing is debt financing. In China, it's a bit different, for whatever reason. So that's part of it. I mean, but it's also again like you can retain if you retain earnings, you don't pay them out, and like that's not gonna. But like like we talk about, or like you're very debt focused because the debt is relatively cheap. So there are other ways it can show up, and local governments are also a big recipient historically. Again, now it's a little trickier to think about what that's how they're doing because again, the property bust has hit them very hard. But I mean, that's a story. They've been big beneficiaries and they still own a lot of productive assets in China.
So when I look at the current Trump administration and President Trump says China is quote unquote cheating on trade, I'm sure there are many things implied by that statement that you would disagree with, and you probably would just disagree with the statement. But the underlying claim, kind of implied by what President Trump is saying, is that there are a whole series of policies that China is doing that almost guarantees that it will have a permanent or persistent trade surplus with the United States, and therefore it will be taking jobs away from America. Like based on the mainstream arguments, mainstream economist arguments explaining why President Trump is wrong. I understand, logically makes sense, but basically, your philosophy along with Michael Pettis, it seems like you would be inclined to agree with President Trump, if not the verbiage, then the underlying claims.
I mean, we may be being excessively charitable in terms of what is meant by that statement, but or what he means when he says those things. I mean, look, I think a lot of people, and this was, by the way, also true of what was being said by officials in the Biden administration. Janet Yellen went to China and made these exact points, right? So I don't think if the argument that we're making is that there are things happening in China that are counterproductive both for China and for the global economy, that is at this point that's a consensus view actually.
Mhm.
Um, so the question is, what do you do about it? And that's where I think it gets trickier. Like I think you know you could argue there are some specific sectors where you might want to have, certain kinds of prohibitive tariffs, like the Biden administration did with electric vehicles. I don't know, like that was I could see it the way, right? But I think the bigger point, the idea that you just block imports from China coming in, I mean, that's ultimately going to be an act. It's in a longer term. If you do it as a whole, like that's an act of self harm. It's like going on a hunger strike because someone else is making too much food, and I don't see that that seems like a negative sum lose lose way to go about, addressing these issues. Um, I think there are probably better approaches you can do. If again, if you zoom out and say, what are the actual negative consequences for Americans or people, anyone outside China for what's been happening in China, and then you start from there and trying to address those specific things, I think you would come to a different kind of approach than we'll just put a lot of tariffs on them and hope they change, which doesn't seem to be working or have worked.
In your conclusion to your book, like 7 different things you recommend China to do. None of them are tariffs, but you write then in the next paragraph that all of these proposals are new. None of these proposals are new, and that they were recommended by mainstream economists in China at in October 2013. So why isn't China doing what needs to be done?
Well, that's what we were saying before, right? I mean, and again, this is a term that officials in China have used, like the vested interests, right? Um, if you have a system that is developed over decades that benefits certain people, small groups of people who've gotten very wealthy and powerful relative to the rest of the population, they're going to have both the means and the incentives uh, to try to block changes. And apparently, so much so that the changes don't happen. So there have been, I mean, it's not like nothing has happened. It's just been very small, right? There's pilot programs of saying maybe we can liberalize the hukou household registration system, which that's the system in China that basically prevents people from the countryside from getting access to city benefits. Um, and so it was created by Mao, by the way, to basically prevent future revolutions of the kind that he led. It's like, well, if people can't leave where their town, then you can't have no mass movement across the country, you can't have a revolution. So that was gradually liberalized, starting in the late 1970s, but only partly, right? Oh, people could move, but they're still kind of technically illegals, and there was always an ambiguity there. And again, there's still the tax benefit imbalance where you pay the local tax, but you don't get benefits. And there have been some pilot programs very recently, like in one particular province, they'll say, okay, you can, if you're from the countryside in this province, you can move to these cities in this province and, maybe get benefits. And, Michael's made the joke, probably has come from people locally. It's like, yeah, you make it so that people can move to the places they don't want to move to. It might be different. Like, which I guess is better than nothing, but it's not really, if it's not happening in places like Beijing and Shanghai and Guangzhou and stuff like that, like, how, I mean, maybe a lot, right? But like, so it's not like there's been literally nothing happening, but very little. People have been talking in China about introducing a property tax for a very long time. It's been official policy, like we should study this and try to do it, and then nothing happens. So that I think is, again, like I think it's totally reasonable to encourage those changes. Again, like they have every reason to do it for themselves, independent of what the rest of the world thinks. But I think if you're a policymaker and outside China, you should start with the presumption that as much as it would be nice for these things to happen, they're not going to happen. And so, what are the things you can do to, you know, minimize the sort of negative spillovers to yourself and your own society?
Treasury Secretary Scott Bessent has made the argument that said, "Look, I've looked through history, and typically in a trade war, the trade deficit country has an advantage over the trade surplus country because if both countries were to enter a total trade embargo on each other, and U.S. exports would go down by 100%, so 150 billion. Chinese exports would go down by 100%, 450 billion. So it would hurt the Chinese economy more, basically, and that gives the U.S., the deficit country, an advantage. You and your author Michael Pettis have also looked through history. To what degree do you agree or disagree with that statement, and why?
So in theory, I think that's right, but with a couple caveats. One is you're assuming sort of roughly comparable pain tolerances in the societies, which might not be true. And the other thing that's tricky is that there's a question of sort of if you lose, if you're, on the deficit country and you cut your imports, um, can you get equivalent replacements from other people? And historically, the answer has been, in general, yes, right? Like you don't have sort of monopoly producers of key goods that are the country you want to ban imports from. That's not really true in the case of China for a variety of reasons. Um, I mean, some of these things are just, like children's books, right? Overwhelmingly are made in China. I don't know why that happened, but that's the case, right? Like, now, is there any economic advantage to America banning children's book? No, right? But like, if you were just mechanically say, like, we're gonna, there are other things that people are paying more attention to because they sound more serious. But like, by the way, it's like I would be upset if I could no longer buy children's books. So, but like, some people have like sort of various critical minerals for earths where like they're not rare in the world, they're in the crust everywhere, but actually refining them and turning them into usable products, that capacity right now basically only exists in China for a lot of things. And so if you suddenly lost access to that, people talk about things like dysprosium or whatever, right? Like that could be a real problem for a whole lot of consumer goods and military goods, industrial goods that you don't even think about until you don't have it, right? And you can say, well, the market value of this stuff is really small. It's like, okay, yes, maybe we're talking about a market that seems like it's like tens of millions of dollars, but suddenly you don't have any, and like you can't make all these other things that have a market value that's much higher. Like at the margin, that market value actually, it looks like it's only tens of millions of dollars now, but it's actually worth a lot more if you don't have any, right? And so that could be a constraint. But I mean, leaving that, so that's really the big question is like, is the extent to which the pain from losing access to imports that can't be replaced offset by the pain of losing income that theoretically could be replaced, but probably wouldn't be. But again, this is all very, you know, negative sum kind of way of thinking about it. But that is, I mean, when people talk about the impact of Smoot-Hawley tariffs in 1930 during the Depression, I think it's worth remembering that part of the reason it was so painful for the U.S. to the extent that it was is because the U.S. at that time was actually a big trade surplus economy, and so the retaliation was much more painful than it would have been in other circumstances. You look at, say, the UK at that point, in 1931, which went off gold and devalued its currency, which is effectively the same thing as putting on the tariff, by the way. It worked out a lot better for them because they were a trade deficit country. So, it's not like the what Besson is saying is completely wrong. I'm not sure it applies necessarily in the case of, the US China situation right now. Because there's some important exceptions to bear in mind. But I mean, it is certainly true that if you are providing income to other people and you have the ability to make more stuff that you're not, then making more stuff at home is going to be more beneficial for you than losing the income. So it kind of depends on how these things add up. But that's the other thing too, right? Like in the Depression in the UK in 1931, there's a lot of spare capacity to make more stuff. In the US now, is that true? Well, that's kind of an open question, right? Like you could say there's spare capacity. I think it's plausible that in certain situations there might be, but like you could also argue not, right? With like looking at sort of the inflation, unemployment numbers and stuff like that. Actually, you'd have to make some sacrifice and move people from certain sectors to others, and that might be again something people don't want to do. To talk about like you lose childcare workers, you have people work in the sock factory, right? Like that's not necessarily going to be something that people are going to be happy with.
Right, and that's another thing I've heard from economists endlessly is that a large reason for the decline in manufacturing employment in America is not globalization. It's just uh, not non-globalization factors, such as like we've gotten way more productive. So, two questions. Number one, if let's say Trump puts a 30% tariff rate on China and keeps it there, how effective do you think that will be in reshoring manufacturing in the US, building things, once again in the United States? And number two, if instead of going on with his tariff policy, President Trump or whoever is president, religiously went to the conclusion of your book and did every single thing that you recommend in the book, how successful would that be in returning manufacturing to America? Or do you agree with a lot of other economists that basically, manufacturing in America is kind of done?
I guess the first thing I would say is that manufacturing employment is not a very good measure of manufacturing, you know, your society's ability to manufacture. Like manufacturing employment in China has gone down over time too, but manufacturing output's gone up, right? That's what you'd expect. That's how productivity works. The, the thing that I think is a legitimate concern is that if you look at manufacturing output in the US, which like the Federal Reserve has been tracking this for over 100 years, and with the exception of the Great Depression, it goes up over time, except since 2000, more or less. Basically been flat. And depending upon how you think about the measurement of manufacturing growth for semiconductors, which is very sensitive to a lot of assumptions about, improved computing power, and that's tricky, right? Because when talking about real output of semiconductors, um, you leave that aside, like it's been down over time since 2000, more or less. So that I think is a much bigger issue to be focused on relative to the employment dynamic. I mean, obviously, we want to have society where everyone has good jobs and can pay for their what they want out of their wage income, and that's what we would hope, even if they want to, right? Like, but that's very, I think, very distinct from the question of like the fate of the manufacturing sector in the United
But
States.
sorry, I mean, the trade wars are class wars. It's about human needs, and the golden age of capitalism, the 50s and 60s, was people who didn't necessarily have a college degree could have a family with two kids, and their spouse didn't have to
Sure, but
work.
yeah,
Yeah.
well, I mean, there's like a lot going. I mean, look, there's lots of things you look at the 50s and 60s that are much worse than now, right? Like
Yeah.
the houses were a lot smaller. They didn't
Yes.
have a lot of the amenities we have, right? Like I would not be too nostalgic for that. If people wanted the material circumstances of the 1950s, they could very easily recreate them now, uh, and affordably. They just wouldn't like it. So, putting that aside, I think that. But if you're, I'm saying, but if you're concerned about manufacturing, like I think that is a legitimate thing to be concerned with, sort of separate from the employment issue. And I think, like, to be honest, the reasons I think why you'd want to be concerned with manufacturing are twofold. One, which is something we didn't talk about in the book because it wasn't the point of the book, but like there's a national security element of like why it's good to have a domestic manufacturing base. I think it's been very clear basically over the past 5 years why that's relevant. 6 years. And then the other thing is that, again, we didn't talk about this in the book, but I think it's also relevant is that high-end manufacturing historically is where a lot of productivity growth economy-wide has come from. And so if you move all of that somewhere, then you lose that or you risk losing it, right? Like one of the big things you've seen in the US recently, and it's had sort of mixed results, is you have design in the US, R&D in the US, and then production somewhere else. That's like been the model, and it's capital light. Investors love it, right? But the problem is sooner or later, a lot of it ends up happening during the manufacturing process, which means that inevitably, or not inevitably, what tends to happen is that you have a lot of R&D and design move to those places, right? There's a reason why a lot of the big American tech companies have big R&D campuses in China. Right? A part of it is obviously there are a lot of very educated, intelligent, hardworking people in China. It makes sense to, if you're a global company, do that. Part of it also is like it's closer to where the production's happening, and so it makes sense to do that too. And so, there's benefits and synergies to be had from having things, integrated. And so that's another reason I think that people should be mindful of the dangers of the lack of manufacturing growth in the United States. And the question of, to your question of if China had different policies, would there be more manufacturing? Yes. I mean, some, right? I think to be fair, like the sort of sectoral interests of manufacturing are there's like some overlap of what we're talking about, and then some that's not, right? Like it's entirely possible that you could imagine a world where national income in the US is higher relative to national spending. So there's no current account deficit. But the difference is coming from things like commodity exports. Um, and then you'd hope that the government would redistribute those extra commodity earnings to people in a way that people were happy and like there'd be extra jobs and healthcare or childcare or whatever, like things that people need, right? But it's not tradable. That is a possible outcome. Um, and that would be consistent with what we talked about in the book. That's separate from the fate of the manufacturing sector, which I think would require, you know, more attention. And that there's a lot of other things you can read about that. But I think it's important to sort of distinguish these. They're related, and manufacturing is obviously affected disproportionately because manufactured goods are traded in a way that services are mostly not traded. And so, if you have a trade imbalance, kind of manufacturing is going to tend to bear the brunt of it. But it doesn't mean that if you eliminate a trade imbalance in a constructive way, that manufacturing is automatically better off. I mean, it might be, but there's a lot of other things you have to think about too.
And what are the solutions, I take it they're not tariffs, that the US could do to restore these imbalances?
I think the starting premise is the imbalances, because they have their origins abroad. You actually, at the aggregate level, there's not a lot you can do about it. So the question is, given that the imbalance is going to happen, if you think that's the case, right? Like maybe it's not, but like if you think the imbalance is going to happen anyway, the question is, how do you mitigate the impact on your domestic economy? And so there are basically a couple of potential costs to be mindful of. One is, if foreign demand is weak and you don't do enough to increase your own domestic demand, then you're going to have, businesses failing and excess unemployment in your own country. And that's bad, right? So first things first is making sure you have sort of the macro stance calibrated to offset any foreign weakness. And that's step one. That's even like before the imbalance. That's just making that in a sense is like preserve the imbalance existing, right? Because if you tank the domestic economy because you're worried about a trade imbalance, like you can do that. Maybe the trade balance goes away, deficit goes away, but like you're worse off. So that's step one. And then step two is saying, okay, well, you want to make sure that this imbalance is the financial consequences of it are not going to be particularly destructive to your domestic economy. And so, if there's going to be, again, like sort of, I think the archetypal example would be the 2000s. If you say, well, okay, foreign demand is weak for whatever reason, we're going to ease monetary policy. That's a very standard textbook thing you do. We have a weak economy, set rates low. I mean, perfectly normal, right? What was the consequence of that happening, given everything else that was going on? The consequence was a massive private sector debt bubble, particularly in housing. That was not sustainable in any way. And
You're
that's
talking
like
about the US in early
yes,
2000s?
yeah.
Yeah, yeah.
From 2008. So that was no good, right? That was not a viable model. So the question is, okay, if someone is going to be borrowing or issuing assets, or be the counterpart to the rest of the world on net in the aggregate buying assets, it should be an entity that can do so basically without having to worry about paying it back. So it could be have a lot of companies sell stock, right? I mean, there are issues there, and like maybe you're getting rid of a lot of productive assets to foreigners cheaply. I don't know. Like but like companies fail or the foreigners pay too high a price because the value, like whatever, right? Like it's not going to necessarily like financial crisis, right? It's much better than what we actually experienced where we had this kind of.
Definitely.
But the other option, which I think is also very reasonable, is say, look, like if people in the rest of the world in the aggregate are looking for things that are relatively safe for whatever reason, give it to them, right? Like treasury bonds. And again, like we can talk, what's happened recently, leaving that aside, like in principle, the federal government can always roll to debt. Um, and its servicing costs are going to be lower than any other entity that would be issuing debt. So let them do it. Um, okay. And then the last thing you say is again, to what we were just talking about before with manufacturing sectors, you don't want to have the composition of your economy be unreasonably, you know, distorted for reasons that have nothing to do with, what's going on internally. It's like you don't want to have perfectly viable industries just get wiped out because of problems, other people are doing things that are not good for them. And so to the extent that maybe you have some kind of support for the manufacturing sector, which could take a lot of different forms, um, maybe do that too. And maybe in fact you could have some of the government debt issuance that you're selling to foreigners to meet their demand for assets, so lead directly, finance the support you provide your domestic manufacturers. I think at a high level, that is a reasonable formula to use. And I think it's also basically, with caveats, right? But like basically, I think that's what the Biden administration tried to do. Because, I can say with confidence, like some people there read the book and thought it was interesting. And I think that's like, I don't think we're the only people saying these kinds of suggestions. But I think putting it together in this framing, I think is sort of unique. And so I think that explains, what that kind of approach, I think would still work. I think you can look at other countries and say like, there are certain places where it worked for them too if they tried. And so I mean, it's not perfect, right? But given if we start from the premise that the rest of the world is not going to change, or particularly the large surplus countries are not going to change their behavior, then it seems like, relatively speaking, the best option available.
And forgive me if you did say it, but I don't think you did. Isn't one solution you mentioned reducing the foreign sector's demand for assets with various measures, whether they be capital controls or others?
Yeah, you could do that too. I mean, To be honest, that's the thing where, you want to be careful about how you go about it. I think, to be honest, that given what's happened with this administration over the past few months, they're probably not the best ones to be implementing that sort of thing. Like in theory, right? What the IMF calls capital flow management measures
Yeah,
are
they're not
perfectly
capital
fine.
control. Capital control sounds extreme, but capital
Yeah.
flow management
Yeah.
matters, now
They
that's
said,
exotic.
I think it was back in 2012. They said, you know what? It's fine now. Like, we made a mistake. It turns out this is perfectly normal part of the macroprudential toolkit. Go for it. And they said that in 2012. And I think that's perfectly reasonable. And I think that, like, if you had a, you know, competent technocratic government kind of laying out a case for how to do this, and kind of in a targeted way, that would also make sense, for the US. And we've seen other countries do things like this, rich countries and developing countries. I don't see why you could not do something like that in the US. There are various things you could do, and again, like, there's a very plausible argument saying we're trying to ensure domestic financial stability. It's sort of a macro prudential kind of regulation. This is the kind of thing where we're going to be, not just, being random here, but kind of in a measured, predictable way, like trying to discourage excessive and volatile inflows, that might distort our own domestic financial system. I think that's totally a reasonable approach as well to integrate. Again, like, it's not as necessary, I think, compared to the other things. It can certainly help. It's sort of a question of, like, how much do you care about the potential for too much government debt issuance in sort of an abstract sense versus, um, you know, the fact that the cost of capital and the cost of imports might go up if you do the other thing. I mean, arguably, there's trade-offs regardless. I think you can have a sort of a balanced approach. But yeah, I think that's totally a reasonable thing to do. Again, though, the challenge is you don't want to have it be implemented by administration that simultaneously do lots of other things that are freaking people out. I mean, arguably, you could say that already we're reducing the appeal of holding U.S. assets, but I think it's doing it in ways that are counterproductive. Like, you're harming Americans more by doing it that way. If creating extreme policy uncertainty and questions about, the rule of law and the university system and so forth, than if you were doing so, like, okay, we're going to have like certain kinds of taxes on foreign investment income, or limits on inflows and outflows of the kind you see in lots of places, whether it's Korea or Chile or Australia or what have you.
And one solution you mentioned is basically for the US government to issue liabilities, AKA run a deficit or large deficit. The US has been doing that, right? And
Yeah.
I think one thing I've think Michael Pettis has said when I've interviewed in the past is that the large current account deficit that the US has basically forces the US to run a fiscal deficit and not have a recession.
Yeah, no, I think that's right. I mean, except for brief periods of time when you can get the private sector to do it instead. But I say brief because they can't do it very long without blowing up. Right. In the late 1990s, you had this huge corporate debt bubble, a massive wave of bankruptcies, and like no bond issues for a while. And then that led to a persistent shift in corporate investment behavior, which was very destructive. So, like, that was not a good model. And then you had the 2000s where then households did it. So the only entity in the US that could sustainably be on the other side, if you have a persistent current account deficit, I think, is the government, over time, right? You can have periods of time when the private sector does it, but I don't think it works out very well. We've seen that before, and it ends badly. And it's not because, like, the U.S. private sector is uniquely bad. I think it's just a function of it's very difficult for any entity, to do that over time in the volumes necessary to accommodate foreign, asset demand.
So what broad conclusions, Matt, can we leave our audience with here today? Because this has been a pretty complicated conversations, a lot of kind of implied equations between savings and investment and consumption and savings and the like
Well,
between
it's all
countries.
addition and subtraction. So at least
Yes.
there's that.
Yes. But what broad conclusions can we draw here?
Sure. Well, first of all, uh, globally, the economy and financial system is a self-contained unit. And so it's very important to remember that everything has to add up at the global level. And so if something happens in one place, it's not going to stay in one place. There will be transmission effects to the rest of the world, and you have to be mindful of that. And you can't just look at one country and say what happening in that country is only the responsibility of that country, that there are other forces externally that can have an impact. It can be quite large. Um, that's a big thing to think about. I think another thing to think about is that there are positive sum solutions, that prosperity globally is not this, contest of one side wins, one side loses. And that the problem with thinking about things that way is it will lead, precisely if you think about things as a negative sum game or zero sum, it will be, in fact, a negative sum game, but it doesn't have to, right? Like, there's large parts of the world still where people are living below their means. And there's lots of material poverty in large parts of the world. And so we should be thinking about, this can change. It doesn't have to be that way. We can all be better off as a result. There might be changes in terms of what individual people are doing or how, the mix of industries and countries or what have you, but like we could all be better off, or at least the vast majority. And then, related to that, think about the context of like the, I don't think the trade war that is we are seeing, or the trade conflict we're seeing in current policy, is going to be good for Americans or the world. I think Americans are liable to be the biggest losers from this. But there are alternative approaches that have been tried to a degree, and were, I think, broadly successful. And I think if we could go back to that, that would be a better option.
Matt, thanks so much for coming on Monetary Matters. People can find you on Twitter at M_C_Klein. And your Substack is the Overshoot. We'll link to that in the description. Tell people what you write about at the Overshoot. And is there anything you cover there that we haven't talked about so far?
Oh man, I'll cover a lot of things there. It's basically, global macro analysis, economics, finance, public policy is what we say. So, I mean, it's just me, but, truly trying to help investors and policymakers, academics understand what's going on. Recently, it's been very heavy on trade and relationship between trade and balance and macro for obvious reasons, but, covering lots of other things, inflation dynamics, U.S. unemployment, generally sort of focus on, major economies, U.S., Japan, China, Europe, but also looking at other places as well.
And Matt, just a question I wanted to ask: what's the relationship between immigration and undocumented immigration and the unemployment rate and the jobs data? Because 2021, 2022, 2023, we saw very strong levels of the job market, very high non-farm payroll growth. I at the time definitely was not connecting that to immigration, and to be honest, I wasn't really aware of the large data of the large immigration in the U.S. Like, just how much of the quote unquote strong labor market that we've seen over the past 4 years has been due to immigration?
That's a great question. I'm not sure it's been that much insofar as when we think of the strong job market, we think about ratios, right? And so if a lot of people were coming into the country and then were not able to find work, then presumably that wouldn't be showing up as a strong job market, right? Somehow, one way or another. I mean, one wrinkle here it's important to know is that we have two surveys, right? There's surveys of employers based on how many people you're paying, and there's surveys of households and saying, like, do you have a job? And there was a big gap, and that gap
Mhm.
was reconciled mostly by saying, oh, like there are more households working than we thought. The employer surveys were closer to the truth, um, which is consistent with the idea that they were undercounting immigration. But the household surveys that had been undercounting immigration were also showing the labor market being very strong in terms of like the proportion of people who were working, within sort of prime age groups, right? So if before any revisions to the estimates of people who are in the country working, you still saw the unemployment rate is very low, employment rate was very high, things like that, then like I don't think it really was moving the needle one way or another. Maybe you could argue for like aggregate GDP, it was having an impact. Um, but it's hard to tell. I don't have like very strong confidence in that view. I mean, it's not nothing. But again, like the per capita numbers, which again have been revised at this point, like they still show that growth is pretty strong. And so like the extent to which US growth has exceeded pre-pandemic forecasts, that's still true. Uh independent. So I don't think it's been huge either way, to be honest.
All right. Well, we'll leave it there. Thanks again, Matt. Reminder: people should subscribe to the Monetary Matters YouTube channel and leave a rating and review on Apple Podcasts, Spotify, or wherever else you get your podcasts. It really helps the show. Thanks again. Until next time.
Thank you, Jack.
Thank you. Just close this door.